Hi, and welcome back to Naseems Accountants. In today's video, we'll be explaining what inheritance tax is, how it works, and who needs to pay it, in simple, easy-to-understand terms. Planning your estate or dealing with the loss of a loved one. Understanding inheritance tax can save your family thousands of pounds. Let's break it down simply. Inheritance tax is a tax on the estate of someone who has passed away. That means everything they owned, from property and money to personal possessions. There's usually no inheritance tax to pay if either the estate's total value is below £325,000, or everything above that amount is left to a spouse, civil partner, or charity. The estate includes things like the person's home, money, cars, shares, or even a business. You'll also need to account for any debts, such as mortgages, credit cards, or unpaid bills. The standard inheritance tax rate is 40%, but it only applies to the value of the estate above the tax-free threshold. If the deceased owned their home, or a share of it, and leaves it to their children or grandchildren, the threshold increases by £175,000, making it £500,000 in total. However, if the estate is worth more than £2 million, this extra allowance starts to reduce. If the home or estate passes to a husband, wife, or civil partner, there's no inheritance tax to pay. If the first partner doesn't use all of their tax-free allowance, the remaining amount can be transferred to the surviving spouse or civil partner, but this must be claimed within 24 months of death. Inheritance tax can be complex, but planning ahead makes a big difference. Book your free consultation now at 01217714161 or visit www.naseems.co.uk. We'll help you protect your family's wealth and plan smartly for the future.